Gary Gensler, the head honcho of the Securities and Exchange Commission, is stepping down. This marks the end of a significant chapter in the SEC's history. He's been in charge since April 2021, a period marked by numerous challenges and significant changes in the financial landscape. His last day is January 20th, 2025. This date coincides with the inauguration of a new president, adding another layer of transition to the political and financial spheres. That's when a new president takes office, potentially bringing new policies and priorities that could reshape the SEC's future direction. Gensler has been a busy bee during his time at the SEC. His tenure has been characterized by a proactive approach to regulation and enforcement. He's taken on Wall Street, crypto bros, and everyone in between. His efforts to regulate the burgeoning cryptocurrency market have been particularly noteworthy. Gensler is known for his tough stance on regulation. He has pushed for greater transparency and accountability across the financial sector. Some say he's been too tough, arguing that his stringent policies have stifled innovation and growth. Others say it was about time someone put their foot down. They believe his actions have been necessary to protect investors and maintain market integrity. Love him or hate him, there's no denying that Gensler has left his mark on the financial world. His policies and actions have sparked debates and discussions that will likely continue long after his departure. His departure comes at a time of great uncertainty for the markets. Interest rates are rising, inflation is soaring. These economic pressures are creating a volatile environment for investors. And the threat of a recession looms large. The economic landscape is fraught with challenges that will require careful navigation by Gensler's successor. What does Gensler's exit mean for investors? Only time will tell. The future of the SEC and its regulatory approach will depend on the new leadership and the evolving economic conditions. As Gensler bids farewell, the financial world watches closely, anticipating the next chapter in the SEC's storied history. His legacy will be debated, but his impact is undeniable. Remember GameStop? Back in 2021, a bunch of Redditors drove up the price of the stock. It was chaos. Hedge funds lost billions. The little guy felt like they finally had a win. The GameStop saga exposed the flaws in our financial system. It showed how easily markets can be manipulated, and it highlighted the growing divide between Wall Street and Main Street. Enter Gary Gensler. He was appointed by President Biden to clean up the mess. Gensler came in with a mandate for change. He promised to level the playing field and restore trust in the markets. The GameStop fiasco was a wake-up call for regulators. It showed that the old rules weren't working. Gensler's mission was clear: adapt or die. Gensler didn't waste any time. He launched a full-scale assault on Wall Street. No one was safe. From hedge funds to crypto exchanges, everyone was in his crosshairs. One of his main targets was the private equity industry. Gensler argued that these firms were too opaque and lacked transparency. He pushed for stricter rules on disclosure and fees. He also went after the big banks. Gensler believed they were still too big to fail. He proposed new regulations to increase their capital requirements. Not everyone was happy with Gensler's aggressive approach. Critics accused him of overreach and stifling innovation. But Gensler was undeterred. He argued that his reforms were necessary to protect investors and ensure the stability of the financial system. The U.S. Treasury market is a big deal. It's the backbone of the global financial system, a place where the U.S. government borrows money to fund everything from infrastructure projects to social programs. It's where the government borrows money, issuing bonds that are bought by investors around the world. These bonds are considered one of the safest investments available, a cornerstone of financial stability. And it's supposed to be the safest market in the world. Investors rely on it to be stable and predictable, a safe haven in times of economic uncertainty. But in 2020, the Treasury market went haywire. Interest rates spiked. Liquidity dried up. It was a mess. The market, which had always been a pillar of stability, suddenly became a source of risk. Gensler knew he had to act fast. As the head of the Securities and Exchange Commission, he was responsible for ensuring the stability and integrity of the financial markets. He implemented a series of reforms to strengthen the Treasury market. These included increased transparency. Gensler wanted to shed light on the shadowy world of Treasury trading. He believed that more transparency would help prevent the kind of market disruptions that had occurred. He pushed for more disclosure of trading activity. Enhanced liquidity. When markets get shaky, liquidity is key. Without it, the market can seize up, making it difficult for investors to buy or sell securities. When markets get shaky, liquidity is key. Gensler wanted to make sure there was always someone willing to buy or sell treasuries, ensuring that the market remained functional even in times of stress. Gensler wanted to make sure there was always someone willing to buy or sell treasuries. Central clearing. This is a fancy way of saying that trades would be settled by a central entity. Central clearing helps to reduce the risk of default by ensuring that all trades are completed in a timely and efficient manner. This would reduce risk in the system. By having a central clearinghouse, the market would be less vulnerable to the kind of disruptions that had caused so much trouble in 2020. Gensler's reforms were designed to make the treasury market more resilient and less prone to panics. By increasing transparency, enhancing liquidity, and implementing central clearing, he aimed to create a more stable and secure financial environment for everyone. Section 5. Equity Market Overhaul. A level playing field for investors. The stock market is supposed to be a level playing field, where every investor, regardless of their background or resources, has an equal opportunity to succeed. But for years, it's been anything but. The reality has been starkly different, with significant advantages skewed towards those with more resources and advanced technology. High-frequency traders, for instance, have been using their speed advantage to rip off ordinary investors. These traders use sophisticated algorithms and lightning-fast connections to execute trades in milliseconds, often capitalizing on tiny price discrepancies before anyone else can react. SEC Chair Gary Gensler was determined to level the playing field. He recognized the inherent unfairness in the current system and was committed to making substantial changes. He proposed a number of reforms to make the equity market fairer for everyone. These reforms were aimed at addressing the systemic issues that have long plagued the market. One of the key reforms included shortening the settlement cycle. The settlement cycle is the time it takes for a trade to settle, which currently can take several days. Gensler wanted to shorten it to 1 day. This change would significantly reduce the risk associated with unsettled trades and free up capital that could be used more efficiently elsewhere. This would reduce risk and free up capital. Narrowing spreads was another crucial reform. The spread is the difference between the bid and ask price of a stock. A narrower spread means that the cost of trading is reduced, which directly benefits investors by making it cheaper to buy and sell stocks. Gensler wanted to narrow spreads to make trading cheaper for investors. Improving order routing was also on his agenda. Order routing is the process by which orders are sent to different exchanges. In the current system, orders are often routed in ways that benefit brokers and high-frequency traders rather than the investors themselves. Gensler wanted to make sure orders were routed fairly and efficiently, ensuring that investors get the best possible execution for their trades. Gensler's reforms were designed to give ordinary investors a fighting chance against the Wall Street sharks. By addressing these key issues, he aimed to restore confidence in the equity markets and ensure that they operate in a manner that is fair and transparent for all participants. These changes are not just about technical adjustments. They represent a fundamental shift towards a more equitable financial system, a system where every investor, regardless of their size or sophistication, can participate on equal footing. The goal is to create a market environment that fosters trust and encourages broader participation, ultimately leading to a healthier and more robust financial ecosystem. With these reforms, the hope is that the stock market will truly become a level playing field where everyone has a fair shot at success. Gary Gensler's tenure at the SEC was marked by his relentless pursuit to bring order to the chaotic world of cryptocurrency. Often referred to as the Wild West of finance, Gensler aimed to implement regulations that would protect investors and ensure market integrity. His efforts were a significant step towards taming this volatile and rapidly evolving sector. Under Gensler's leadership, the SEC took a firm stance on enforcement. Companies and individuals who violated securities laws faced stringent penalties. Gensler's commitment to holding wrongdoers accountable was evident in the numerous high-profile cases prosecuted during his time in office. This approach reinforced the SEC's role as a vigilant watchdog for the financial markets.
Check one, check.
Despite Gensler's clear regulatory vision, his tenure was not without challenges. The rapidly changing landscape of digital assets led to a climate of uncertainty and speculation. Market participants often found themselves navigating uncharted waters as new regulations and guidelines were introduced. This period of transition was marked by both optimism and apprehension within the financial community. As Gensler's tenure came to an end, it was clear that his influence would be felt for years to come. His transformative policies and rigorous enforcement actions left an indelible mark on the SEC and the broader financial markets. Gensler's legacy is one of innovation, accountability, and a steadfast commitment to investor protection. His time at the SEC set a new standard for regulatory oversight in an increasingly complex financial world. Don't miss the bus and subscribe.